When active traders hit a losing streak, they almost immediately look outward for solutions. We buy cleaner chart layout tools, we tweak moving average periods, and subscribe to premium news feeds. Yet 89% of retail traders still fail. We often spend years obsessing over the market's behavior, while leaving our own internal decision-making and execution habits completely unexamined. I wanted to see what happens when you turn the analytical power of modern machine learning inward. I took 120 of my own live, real-money trades, complete with exact entry prices, stop losses, and a self-assessed emotional rating, and fed the entire journal directly into an AI model. I didn't ask the machine to predict where the market was going next. I gave it a specific set of instructions: act as an objective, emotionless risk manager, audit this data, and find the single biggest leak in my execution. True performance optimization requires us to stop treating the market as the enemy and start diagnosing the inventory management of our own minds. The AI returned its first major diagnostic in seconds. My raw technical strategy actually carried a net positive expectancy of 1.45 R. The bleeding was coming from a very specific window, the first 15 minutes of the New York trading session. This animated graph plots my theoretical returns against my actual performance. The blue line represents the strategy executed perfectly. The red line reveals what actually happened during the 9:30 to 9:45 a.m. window. In my head, I was being decisive and aggressively catching the open. The data stripped away that narrative. During that 15-minute block, my win rate dropped to exactly 28.5%. Look closely at this chaotic opening section. By entering the market 30 minutes earlier than necessary, I was subjecting my positions to institutional order filling, wider bid-ask spreads, and erratic algorithmic liquidity sweeps. The stops weren't failing because the structural bias was wrong. They were failing because I placed micromanaged risk brackets inside an unshaped macro clearing zone. The objective data revealed a hard truth. I was reacting to the noise of the opening bell rather than following a calculated statistical edge. The second discovery was entirely psychological. Because I had logged my emotional state on a scale of 1 to 5 before every entry, the model was able to cross-reference my frustration levels with the precise timestamps of every trade. This timeline illustrates exactly what happened after a frustrating loss. Instead of waiting the usual hour and a half for a valid setup, I jumped right back into the market within 12 minutes. Worse, I quietly increased my position size by an average of 42% above my baseline risk. Behavioral economists like Daniel Kahneman won a Nobel Prize for proving why human beings do this. It's called prospect theory. We feel the pain of a financial loss twice as intensely as we enjoy the pleasure of an equivalent gain. When you take a financial hit, your brain doesn't register it as a simple statistical cost of doing business. It releases cortisol, shifting your cognitive processing away from the strategic prefrontal cortex and straight into the amygdala, the biological center for fight or flight instincts. During this loss cascade, biological survival instincts take over. You convince yourself you're just getting a better price on a re-entry, but you're really lying to yourself to protect your ego. The analysis also uncovered a high-performance profile hidden within the journal entries. The AI isolated a specific subcategory of 34 trades where I waited for the 1-hour chart to establish clear direction before entering. In this structural safe zone, my win rate hit 71.4%, generating an average 2.35 R multiple with 0 recorded emotional variance. Maximizing profitability requires a simple mathematical subtraction. Eliminate your high-effort, low-yield mistakes, and aggressively scale up your proven strengths. Raw analytical insights remain useless until you convert them into rigid, enforceable operational protocols that completely remove human emotion from live execution. The AI generated 3 strict rules. First, a hardware-level time lock preventing any live market orders before 10 a.m. Second, a behavioral circuit breaker where 2 consecutive losses trigger a mandatory 120-minute platform cooldown. Third, a strict 4-point pre-flight checklist that must be answered before a single order is sent to the broker. But before you hand your journal over to an algorithm, you need to understand the severe limitations of machine learning in finance. At one point, the AI confidently instructed me to double my position size on Tuesdays because my win rate was higher. With a sample size of 120 trades, that is pure statistical noise. It also told me to abandon a specific setup, completely unaware that those losses happened during massive non-farm payroll news spikes because I hadn't fed it a macroeconomic calendar. The machine reads numbers. It doesn't feel market regime shifts. Artificial intelligence serves as an incredible diagnostic mirror, but human judgment and macro awareness must remain the final operational filter. The financial market is a completely neutral arena. It doesn't know your entry price, and it certainly doesn't care about your financial goals or your ego. The market doesn't remember your last trade, but your internal habits do. The most durable trading edge is built on a foundation of clinical, objective auditing of our own behavior.